Thank you for meeting with me again. Last time, we covered the basics of insurance, and I'm starting to understand how risk is shared across individuals and businesses. But I've heard a lot about reinsurance, and I'm not entirely sure what it is or why it's so important. Could we go deeper into that today?
Absolutely. Reinsurance is a critical aspect of the insurance world, but it often doesn't get the same level of attention as primary insurance. Simply put, reinsurance is the insurance that insurance companies purchase to manage their own risk. Just as individuals or businesses buy insurance to protect against unforeseen losses, insurers use reinsurance to safeguard themselves against significant financial strain.
So, it's like a safety net for insurers?
Exactly. Reinsurance allows insurers to transfer some of the risks they take on from their policyholders to another insurance company, known as the reinsurer. This transfer helps primary insurers manage large claims or catastrophic events without destabilizing their own financial standing.
Can you give me an example?
Let's say an insurance company writes policies in a region prone to hurricanes. When a major hurricane hits, they might receive a flood of claims, no pun intended, far greater than they anticipated. These claims could be so large that the insurer would struggle to pay them all without reinsurance. By having a reinsurer cover a portion of those claims, the insurer can spread out the financial impact, protecting their capital and ensuring they can continue to operate.
Ah, I see. It's a way to protect against worst-case scenarios.
Exactly. There are different types of reinsurance arrangements, too, depending on the insurer's needs. The most common forms are proportional reinsurance and non-proportional reinsurance.
What's the difference between those?
Good question. In proportional reinsurance, the insurer and the reinsurer share both the premiums and the claims in a pre-agreed ratio. For example, if an insurance company and a reinsurer agree to a 70-30 split, the reinsurer will take on 30% of both the premiums collected and any claims paid out. This way, the reinsurer shares in both the risks and the rewards.
So, in proportional reinsurance, everything is split based on a specific percentage?
Exactly. It's a simple and straightforward way to share risk. On the other hand, non-proportional reinsurance, which is sometimes called excess of loss reinsurance, works differently. In this model, the reinsurer only steps in after the insurer has covered losses up to a certain threshold, known as the retention limit or attachment point. For example, if an insurer agrees to a $10 million retention, they will cover all claims up to $10 million. Once that limit is exceeded, the reinsurer covers the excess amount.
So, with non-proportional reinsurance, the reinsurer isn't involved unless the claims go beyond that set limit?
That's right. Non-proportional reinsurance is often used to cover catastrophic events where losses can be unpredictable and severe. It allows insurers to protect themselves from those high-severity, low-frequency events that could otherwise cause financial instability.
It sounds like reinsurance is a way for insurers to take on more risk than they could handle alone. Is that fair to say?
Absolutely. By transferring some of their risk to reinsurers, primary insurers can underwrite larger or more complex policies than they might otherwise be comfortable with. It's a way for them to expand their capacity and offer coverage for a wider variety of risks without putting themselves in financial jeopardy.